Well, hello everyone, and good to see you all on this Thanksgiving week. This is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. All right, well, to help me know if you can hear my voice and see the webinar screen, give me a hello in the questions area. You could even maybe tell me what city or country you're watching from. That's always fun. And while you're doing that, I'll mention that today's broadcast is from San Diego, California, and we do love questions. So when you have questions on the material that we're presenting, please do put those questions in the questions area. All right, well, looks like we've got folks from all around, and welcome to Barton and Bill and John and so many others. So good to see you all here. Tonight's event is about Elliott Wave, and it's a really great strategy that Bennett's going to show you on how to catch wave 5. So Bennett has, of course, written many books, one of which is entitled Elliott Wave Techniques Simplified. And many of you, I think, have that book for sure. And I believe there's some more details on the strategy in that book. Well, Bennett, without further ado, I think I will turn it over to you.
All right, Gene, thanks so much. Assume everybody can hear me okay. Welcome to today's webinar, and also happy Thanksgiving for all of you tomorrow, okay? Have a safe trip and enjoy being time with your family. All right, so we're going to talk about catching Elliott Wave 5, which occurs, of course, after Elliott Wave 4. Before we get into those actual techniques, I want to go give you a little history on the Elliott Wave and talk a little bit about the Elliott Wave in case you're new and kind of not sure exactly what the Elliott Wave is and what's going on. So before we get started, just a few quick little items on risk control. Please know how to do it, you know, and understand that there are risks involved in trading the financial markets. You know, it's always possible to lose some or all your money trading the markets, and that's why you need to use risk control and risk capital. And of course, check with your money manager to be sure any of the ideas that we talk about today are suitable for you. So that's kind of important. And visit us at traderscoach.com. This is a picture of myself many years ago. I guess we need to do an updated picture. I'm a little older now. But in any case, we'd love to have you come over to the website. All right, Elliott Wave Techniques is basically where the material is coming out of for today's webinar. You can get this, of course, at Amazon or any of the major bookstores. And this book was published by, what is it, Wiley or McGraw-Hill? I can't remember. One of those two publishers, but
McGraw-Hill.
Let's move on and talk. Oh, McGraw-Hill, there you go. Now, all right, so what is the Elliott Wave? All right, the Elliott Wave principle is a form of technical analysis. So it's not fundamental analysis. We're not looking at, you know, PE ratios and who's running the company. It's strictly technical analysis. And traders and investors use it to forecast trends, cycles in the markets. And once we have that information, we then can also use different forms of technical analysis like Fibonacci extensions, retracements, to get some target zones on where we think prices are going. So it's kind of a roadmap of the markets. It's really cool. The Wave principle states that collective investor psychology or crowd psychology moves from optimism to pessimism and back again. And so we see this kind of movement in price activity represented by not only volume, but momentum, how fast price moves over time. And in certain of the waves that we look at in the market or these trending type of movements, some are more optimistic than others, and therefore the momentum and volume tends to be greater in those particular moves. So we're going to talk about that as well. But in any case, these swings create patterns as evidenced by price movements of a market at every degree of a trend. So for example, if the trend is moving up, all right, that's a bullish cycle. Moving back is a bearish cycle. And then when it swings back, that is a bullish cycle. So it moves in all degrees of the trend. Now, the guy who founded this, he didn't create it. He kind of discovered it, actually. His name was Ralph Nelson Elliott. And this was way a long time ago, back really in the early 1900s. He was born in 1871, so there you go, going further back. He was an accountant, all right, and actually almost died in 1929 and was bedridden for quite some time. And it was during this period that he started to study the markets. Now, from my knowledge of him, he always had an inkling to the markets, but his real trade was an accountant. But when he got sick, it gave him time to get out of the office and recover. And while he was doing it, he wanted something to do. And so he started looking at charts of markets. Now, back then, you didn't have computers, obviously. And so you had these big paper, almost like mural sized charts of the market. And it was very rudimentary compared to today. But they recorded the price on these charts, and he would look at them for the various different markets that he was able to get his hands on. And he did it for quite some time. So what he found by looking at chart after chart after chart of these different markets is he found patterns in the market. And I would say probably one of his first books was actually called The Wave Principle, and that was revealed in 1938. All right, so as you can see, that's almost 10 years he was recuperating. And then his final work called Nature's Law was published in 1946, and he died in 48. Now, what's interesting about him is when I say he didn't create it, he really didn't, because the market is the market and the price was the price. It's always been there. What he discovered was that trends tend to move in certain wave sequences. And so that's what we're going to be talking about today. So it's very interesting that he could actually see this without a computer looking at paper charts. I think definitely a lot of study. All right, now why do we like it? Why do we use it? Well, we obviously like it because it kind of gives us an idea of the market cycle. Are we in a pessimistic cycle, an optimistic cycle? Where are we? So we use it for forecasting price movement, obviously for profit. And again, it is a form of technical analysis that encompasses mass psychology. And that is kind of a big difference, because now we're talking about patterns in the market, waves that move up, pull back, move up, pull back. And these waves that are created by mass psychology. All right. Yeah, a trend can go up, a stock can go up based on its earnings and things like that. But when you look at how it gets from point A to point B, that's usually a form of mass psychology representing trading based off fear and greed. All right, so that's kind of an interesting part about it. And we use it for establishing price target zones. And once we know where prices we think are going, where they are now, where the previous wave started, then we start to have an idea of where to put our stops, where to expect markets to go, and therefore we can calculate our risk to reward expectations. So when you think of the Elliott Wave, think of it kind of as an overall roadmap of the markets. All right, that's the best way to think about it. Now, when we talk about Elliott Wave basics, what we're going to focus on first is this slide, this part of the slide over here. And that represents what Elliott found, in that when your market is trending up, all right, it is usually made up of 5 waves, 1, 2, 3, 4, and 5. And because markets don't always move straight up, they zigzag because of those periods of profit taking, fear, greed, profit taking, whatever you want to call it. That's what he saw. And so wave 1 was up, wave 2 was profit taking, 3 was more of a move towards in the direction of the trend, wave 4 was a pullback, profit taking, wave 5 usually was the final leg up that he noticed. And once you ended up with 1, 2, 3, 4, 5s in a pattern you could clearly see, the trend ended and came down. I'm going to show you some examples shortly on charts of how this looks and what exactly happened, and it does happen in real life. All right, so that's kind of the basics of the Elliott Wave. So when you think of a trend, think of 5 waves up. Now, notice that there are these small little numbers inside waves. These are actually the minor trends or the minor zigzag patterns that make up the larger movement in the market. So if you notice waves 1, which represent a large move up, after the correction, you have wave 3. After the next correction, you have the wave 4. So wave 1, 3, and 5 are all classified by Elliott as impulsive waves. So these basically, think of impulsive waves as waves of the Elliott wave moving in the direction of the major trend. All right, now if we take a look at what the definition of a trend is, it's higher highs and higher lows, isn't it? So obviously the trend is up, right? So we have 1, 2, and then a higher high. 1, 2, and then a higher high. All right, so there is your trending pattern up. So all the impulsive waves are going to be up in the direction of the trend. Now, another thing he noticed is that during these pullbacks, which are waves 2 and 4, that's these circles in here, he noticed that the waves, the smaller subwaves inside those corrections usually were made up of an ABC pattern. So they were a little different than the 1, 2, 3, 4, 5s that made up the impulsive waves. And so what he classified that as a classic ABC or zigzag correction. Now there's different types of corrections, and we'll get into that in just a little bit. But to keep it simple, most corrections are ABC. Now what's interesting, and here's where you can go down the rabbit hole again, notice that a wave in a correction moves in the direction of the correction. So basically, if we think about the definition of an impulsive wave, it's always some form of a wave moving in the direction of the major movement. So in this case here, we happen now to be moving down into a wave 2. So wave A, and then you have wave B, and then C. So A and C are impulsive waves because they're moving in the direction of wave 2. Now, because they're impulsive waves, we go over here, and you can see A and C moving in the direction of any correction. There's always going to be a 1, 2, 3, 4, 5, and then you have an ABC 1, 2, 3, 4, 5. So you have smaller subwaves in A that represent 5 waves, and the same with C. And then after wave 2 completes, we once again move in the direction of the major trend, which is an impulsive wave in the direction of the bullish trend. And therefore we have a larger subwave of 1, 2, 3, 4, 5 in that particular pattern as well. So that is basically what Elliott discovered when he looked at charts. And he probably looked at charts similar to what I'm going to show you here, which is an example of Apple stock a while back. Now, this was very interesting because on this chart, you can't always clearly see the subwaves inside the major waves, but you can on this chart, which makes it so outstanding to show from an educational standpoint. So once again, the trend starts at this little area I'll put down as 0.0 on the far lower left. And our first impulsive wave here is 1. Then we have a 2 corrective wave. Then we have a 3. Then we have a 4. And then we end the trend with the final 5th wave up. And that is exactly what happened on Apple stock here. And then it trailed off and actually created a new trend to the downside. So what's interesting about this chart is notice the smaller waves in the impulsive waves. And you can see those. You can't always see those on the same chart you're looking at. So for example, if this is a daily chart, sometimes you would have to maybe go down to a 60-minute chart and see the smaller waves inside. Likewise, if this was a weekly chart, then you could probably see the smaller waves on a daily chart. But in this case, it was one chart and the waves were distinctive enough that we could really count them without having to go to a different time frame. So it's kind of cool to see it. And then here's the ABC, but notice how hard, let me just erase this for a minute. Notice how hard it is to see the 5 waves here in A or in here. I mean, you can barely see them, just a teeny bit. So you would have to go to like a 60-minute chart in order to get down into the minor subwaves there. So here we're able to see ABC, but to go down into a lower level here, or here, or here, you're going to have to go to a lower time frame. So that's kind of an interesting aspect here. All right, and then we ended 2, and then we began 3, and there's our 3 waves there. And then we have an ABC correction, and then we hit the final wave up. And again, it's an impulsive wave, so there are 5 waves inside the structure of that chart. Kind of interesting, isn't it? I think that's pretty cool. All right, so that is the basics of the Elliott wave in a nutshell. There's a lot more to it, of course. There's a lot of math behind it, and there's a lot of retracement statistics that you have to know in order to do it. But for the basic part of it, that's how they kind of look and operate and move. Now, what I also want to talk about a little bit in this slideshow today is the importance of watch lists, because eventually, don't forget, our topic was how to trade wave 5s, right? And so in order to trade wave 5s, we have to find stocks that have either just finished wave 4 or perhaps are going to be going into a wave 4, and then we want to get ready and trade the next impulsive wave, which is wave 5. So chances are you're going to have to create watch lists in order to kind of put certain markets that are close to going into a wave 5 in a watch list so you don't miss them. Okay, makes sense, right? All right, so why use watch lists? Well, it organizes your trading for one thing, okay? It allows you to sort and quickly find trading opportunities that you're keeping an eye on, like perhaps an Elliott Wave 5 trade. Eliminates the need for too many open charts at one time, which slows down your system. So when you create a watch list, I'm going to show you a couple examples of doing that on various charting platforms, but I think I'll stick probably with NinjaTrader, but it's the same with anything. But basically, if you create this watch list, you can have the symbols in the watch list and not have to have the charts open. So that's kind of what that number 3 means on that. So it doesn't use as much resources on your computer. All right, and certainly by doing this, not only are you doing organization, but it simplifies the process. All right, so I'm going to show you on NinjaTrader, they have a scanner called the Market Analyzer, and this is where we create watch lists. How many people out there are using Ninja? Now, if you're using TradeStation or multi-charts or MT4, I think you have the ability to create watch lists also. And so you can basically, I think in TradeStation, of course, it's radar screen. So you can just create different tabs as well, just like we're doing in this example. Okay, so either or, it doesn't matter. All right, so in a case like this, all right, basically you can just create a tab called watch list. All right, now if you want to be more specific, you could create one that says watch list Elliott Wave 5. Okay, and that shows you that you're looking for a wave 5 in that watch list. So when you go through, for example, the major sort, all right, for example, here under the description, you know, you can take a look at these stocks and see which ones are just getting primed up for an Elliott Wave 5 trade. Kind of cool. And of course, we have a scanner that can help you do that here as well. The Elliott Wave 3 and Elliott Wave 5 scanner that plugs into NinjaTrader. Okay, so if you come across like a 3 or a 5, you can look at the let me go back for real quick 1 second. You can look, for example, if you have an Elliott Wave 3, all right, obviously that's not getting ready for a 5, but you can look at it and see if it's a possible Elliott Wave 3 trade. If you missed it, well, you might want to put it on a watch list because it's got to go into 4 and then it will go into 5. So I'll leave that up to how you want to sort that. If you see it's in a bull wave 5, then immediately look at it and see if you can get in time for the Elliott Wave 5 trade. All right, and that's how you kind of do it. So if you're scanning these every day and you see a bull wave 5 appear brand new, then chances are you're going to be able to get into that early, right? So it's kind of very handy to have that. All right, so that's one of the things we do in order to trade those. And those scanners are available on TradeStation, NinjaTrader multi-charts, and you can read more about them on our website. All right, and this is just an example of what the Elliott Wave scanner looks like on a list of stocks. I believe this is probably the NASDAQ list, or it could be the Dow, I guess, or S&P. But in any case, that's what it shows us. It shows us when something's in a bull wave 3 and something's in a bull or bearish wave 5. All right, and here's what it looks like on TradeStation's radar screen, which is the same for multi-charts as well. So it just gives you your wave 5 and bull wave 3s, or if it's bearish, it'll show you bearish, okay? And then your settings are all done in here. All right, so the main thing is that you can scan for that, okay? So now when we look at some of these scans, actually, here's, for example, here's a bear wave 3. So let's say, you know, we didn't catch it when it was up here. We just finished the course here today and you ran home, you got the scanner, and now you scan and you say, oh my goodness, here's a bear wave 3. All right, well, it's kind of ending and it looks like to me it could be going into a 4. So get this on a watch list for your next wave 5 trade. All right, so just because it's a bear 3 does not necessarily mean, all right, and it's in a mature bear 3, does not necessarily mean you missed the entire opportunity for trading. You may have missed wave 3 for trading, but you have an opportunity for wave 5 after the correction. All right, here's an example of finding a wave 5 in motion as well. All right, here's your 3, here's your 4, and here's your 5. Okay, so there you go. All right, again, all right, if you look in here when it turns, you'll be able to get in early. Now, if you miss it and your target zone is up here, you obviously have a chance to still get higher. But if you miss it, if the prices are already up here during the 5, then you might be able to catch the next move down. All right, so the idea is you want to move as many of these as you can to either taking the trade, or if you see an opportunity, you can enter it maybe during a pullback or right after wave 4 ends. So that's kind of the idea behind scanning. All right, and here's just some more examples. Here's a great example of a bull wave 3. Okay, all right, so obviously this would have shown up a lot earlier, but in this case here, for this example, what I want to try to show you here is that this is a 3. After 3, you're going to have the 4 at some point. That's when you can catch the next move up for a 5. So even though you may have missed 3, don't throw the towel in, because you still can possibly catch wave 5 on that, right? Okay, so keep that in mind. Here's that other one now going up into its final high in wave 5. So according to Elliott, obviously, this would be a 3 here. This would be a 4. Here's your A, B, C correction. All right, and now we're into 5. And if you do the fib extensions, you'll probably get a target on 5 right about there. So that would end the trend, and then it will change direction. All right, any questions? Any questions out there? It's kind of cool stuff, isn't it? All right, good. All right, so glad you like it. All right, so how to get a breakout. All right, so when we talk about catching a bullish wave 5, which is what we're going to focus on, I have a book that I wrote on this, and the rules are also in the book. So you might want to get the book, okay? It will actually, it's really, really good in terms of covering this material that I'm covering right now in more detail, but it also gives you this list of what to do. And so we have a variety of different things we like to do in order to catch wave 5. I'm going to bring up for a minute the whiteboard here. And on this here, I'm just going to draw in a bullish trend represented by Elliott waves. And this is your 3. And so when we look to get into 5, we kind of want to make sure wave 4 is over. Makes sense, right? So there's a couple things that we do to kind of verify that as much as we possibly can, because we don't want to get in the middle of a wave 4 and get stopped out, right? So we're kind of trying to pick a bottom of wave 4 before we go into a wave 5. So when we talk about connecting the dots, let's, not really talk about any specific software, but some of the basic tools that you have available for you on just about any charting platform. So the first thing we want to do is kind of verify the wave 3. And from the writings of Elliott himself, basically wave 3s are pretty easy to find because they are usually the most powerful wave in a trend. And they move the fastest, they have the most volume, and they have the most momentum. And thanks to computers today, we can actually look at the momentum in any particular movement in the market as well as the volume. So that's the first clue, okay? It's pretty distinctive. Then after 3 ends, we have a couple of software tools we use. One's the OWL, the Optimum Wave Locator. So when that has to go red for an Elliott Wave 4. So it would be green the entire way up on 3. And then when 3 rolls over, wave 4 will generate a red owl at some point during the wave 4. So that gives us a clue, right? So the next thing we do is kind of, when that seems to be occurring, we draw Fibonacci retracements. And I have another course that I teach on this, but I've devised a way to draw these retracements a little bit differently than how most people do it, to create a probability index of the retracement. So usually what we're looking for is where prices are going to end in terms of probability most of the time on a wave 4. So we achieve that through our fib retracement calculations, all right, or drawing tools. And we get that down into there. So the dot we want to connect is, where is the target zone? Where are prices now in the correction? Have they reached the target zone? And if not, then we got to wait for that to reach the target zone before we can consider it going into a possible another bullish run into wave 5. So one of the dots we look for, okay, here is spotting wave 3, right? So we'll put dots 3. We want to find a wave 3. We want to make sure wave 4 is over. All right, that's another dot we want to connect. And we use fibs for that, okay? And then another thing I like to I call clarity, all right? Do I see an ABC pattern in this correction? If I do, then that's a really good sign, because I kind of want to see that clearly, even if it reaches the target zone. So the more of these dots I can connect, the better. Then when the market moves off the bottom of 4, the owl needs to turn green. That's a dot I connect, okay? Oh, and the owl has to be a red owl. That's another dot to connect. So the owl has to be red for it to be a wave 4. But then when it climbs out, it has to turn green. And then it has to take out some key support levels that formed on these smaller waves inside C wave. So we want to make sure we take out that wave. And then once we do that, okay, then you can either enter here, all right, or maybe you'll have a correction area where you can enter here if you miss it there. So the idea here is that once you have wave 4 hitting enough of these dots to give you confidence it's over, you then can get ready to take the trade to the long side. Now, where is the wave 5 going to end? Well, that is going to be determined using fib extensions. And if you remember fib extensions, use 3 anchoring points. So 2, 3, and the bottom of 4 will give you the target for wave 5. And so if we know the target, then we know, hey, are we entering early enough to make a good 2-to-1 risk to reward trade to the target area if we put our stop maybe down here, okay? It's always best to try to get in as early as you can in a 5 and get your stop as low as possible, okay? That way you get stopped out only if you misjudged the bottom of wave 4 and not getting stopped out on just normal volatility, okay? So that's kind of the premise of what all these rules cover here, okay, over here. So they walk you through that, but I just visually showed you what basically they look like. All right, and of course in the book I also have, that's a bullish and this is bearish. So you see this says bearish and then the slide before says bullish. So basically it's the same procedure, just inverted, okay? Just inverted. All right, any questions on that? And once you get good at it, it is really good. Connecting the dots gives you clarity on the wave count. So that's a very important aspect of being good at this. All right, so as a quick summary here, okay, the Elliott Wave can boost your bottom line by adding a lot more structure in where you are in the market cycle. If you combine that with also scanning techniques and some of our scanners, you'll be able to more easily find the Elliott waves you want to trade, the impulsive Elliott waves you want to trade, whether it's a wave 3 or a wave 5. All right, and then of course, trading rules for catching the impulsive Elliott waves, what we kind of went over on the whiteboard. Okay, so that's kind of what we're looking at. So all those add up to a pretty sound trading approach on the Elliott wave. All right, so any questions? Because that's pretty much what I wanted to cover. I didn't want to go over too much to over confuse everybody, but I wanted to cover some of the basics on how to trade the Elliott wave, and more specifically, how to trade Elliott Wave 5. All right, so let me see. Okay, so a couple questions coming in. All right, can this be used on intraday time frames as well? The answer is yes. You know, I have a day trading room that I run where we actually trade the futures markets, and we trade a variety of them, and we're always basically using the Elliott wave analysis before entering a trade. Kind of get an idea, are we in a wave 5? Are we in a wave 3? Are we in a correction 4? So yes, they can be used on all time frames in all markets. And one of the unique aspects about the Elliott wave is that you kind of can go down the rabbit hole a little bit, in that there's always going to be waves inside waves. So whatever chart you're looking at, you know, let's say you're looking at a daily chart, that daily chart is going to represent a subwave of a higher time frame. And yet at the same time, on lower time frames than the daily chart, you'll have subwaves inside the daily chart represented on those lower time frames. So it's kind of like a snowflake, in that you have crystals inside crystals, right? So that's kind of the thing about the Elliott wave, which is kind of unique. All right, so that's kind of what I wanted to cover today. Let me just see, I think there's a couple more questions here. We got quite a few people here. All right, yeah, so what we try to do, here's something we get a lot in terms of, you know, Ben, you know, how do you take the subjectivity out of the wave counts? And how we do that is basically by connecting those dots. All right, so if you know that wave 3 produces the largest owl, okay, and you look at prices when the owl is showing you a wave 3, then, because the owl has that little wave 3 if you're using NinjaTrader, or the pink dot if you're using TradeStation, then immediately look at the price corresponding to that owl. And if the price is in sync with what the owl is telling you, then obviously that's a wave 3. Okay, and then you're there. And so that can take the subjectivity right out right then, because after that, you know, you have a wave 4, and then you have a wave 5. Okay, and after a wave 5, the trend changes, and so then you can catch the brand new trend the other way. Now, another thing that's interesting too is after you usually get for a wave 5, all right, a lot of times what happens, especially if wave 5 comes, it's a bearish wave 5, and you have a bottom on the market, a lot of times instead of getting that V-shaped bottom, you'll get a bottom that forms a bracketing market. All right, so that gives you an opportunity then to get ready for trading the entire 5 waves right from the get-go of that bracket. So when markets break out of that bracket, you know it's going to trend, and then the 5 waves should unfold. All right, so kind of cool. All right, but you know, it's just a matter of connecting the dots to take that subjectivity out of the wave count. And put it this way, if you look at a chart and you can't see the structure at all that clear, and you've got momentum oscillating to positive to negative, then you're in some kind of messy channeling market, okay, then move on, all right, because that time frame is telling you you are in a correction, probably of a larger degree on a higher time frame. And so that's why you're seeing all that mess on the chart you're looking at. So just move on. Go for clarity. That's the key. Okay. That's it. All right. So that's it. Let me just see if there's anything else. Any other questions? Going once, going twice. All right. Here's another question. Can this be used on the Forex market? Yes. All right. You can use this on any market, any time frame, because basically you have fear and greed on all markets, don't you? And that's really what we're looking at here. The waves are caused by profit taking from fear and greed and getting into new markets and so forth. And that's why when you get a wave 3 near the end, it gets so hyperbolic because you're having so much emotion in the market at that time. People don't want to miss the trend, so they're just piling in. And then, of course, it comes to a point where they're piling in too late and the trend reverses because fear sets in and people take profits because the market got too out of control, right? So it's that constant fear and greed that we see on all markets and all time frames. Kind of cool. It's amazing how well it works. All right, I think I got them all. All right, so Gene, I'm going to turn it back over to you. I want to thank everybody for coming again. Have a great Thanksgiving, and great to have you here. And we're doing these, I think, once a month. We do Wednesday night lives where we focus on one topic once a month. So we'll be back in December, but don't forget, as clients, you can come to the client support webinars that we have every week as well. All right, my pleasure, everybody. Thank you so much for being here. All right, Gene, back to you.
Well, hello, everybody. And Chris, thank you. Chris is literally up the block in San Diego. And Deepak, good to see you here. You'll have to give me a call and we can catch up. Good questions too, Deepak, on the subjectivity. And I think what Bennett was saying is, yes, you can take the subjectivity out. So that is something that you can work on. And of course, you can come to client support every Wednesday. Neil, good to see you. Yes, you have a great Thanksgiving, even though you're in Canada. You can still have turkey, right? So anyway, hope everyone's doing terrific. And we look forward to seeing you next month for Wednesday Night Live. Have a great night.